Most investors begin with a narrow map. They invest where they live, where the language is familiar, where the news is constant, and where the rules feel understandable. This instinct is natural. It is also limiting. Books on global investing often begin by confronting this quiet bias, the belief that safety lives close to home. History suggests the opposite. Safety in investing has rarely come from familiarity. It has come from diversification across systems that fail at different times. Serious books on international investing do not open with exotic stock picks or tales of overnight fortunes abroad. They begin with context. The global economy is not a collection of isolated markets, but a web of interdependent cycles. Growth rotates, capital migrates. Political risk rises in one region, while innovation accelerates in another. Investors who restrict themselves to one country are not conservative. They are concentrated. One of the earliest lessons global investing books teach is that home country bias is emotional, not rational. Investors overestimate the stability of their own systems and underestimate risks they have grown accustomed to. Inflation, currency, debasement, demographic decline, and political shifts often feel invisible until they are unavoidable. International exposure is not about chasing higher returns first. It is about reducing the chance that a single national failure defines your financial future. These books also emphasize that global investing is not a bet on foreignness, but a bet on variety. Different countries specialize in different strengths. Some lead in manufacturing efficiency, others in innovation, commodities, demographics, or financial services. By investing globally, capital participates in multiple growth engines, rather than relying on one narrative to persist indefinitely. Another recurring theme is that international markets move on different timelines. While one economy stagnates, another may be reforming. While one market is expensive, another may be undervalued due to temporary pessimism. Books highlight how patient investors who study cycles rather than headlines can find opportunity precisely where attention is lowest. Currency plays a central role in these discussions. Global investing books explain that currency risk is not merely a hazard to avoid, but a dimension to understand. When domestic currency weakens, foreign assets can preserve or increase purchasing power. When currency strengthens, international investments may underperform temporarily. Over long horizons, currency exposure acts as insurance rather than speculation. These books are also careful to dismantle the myth that global investing requires expert-level geopolitical forecasting. Successful international investors do not predict elections or wars. They design portfolios that are resilient to uncertainty. Diversification across regions, currencies, and political systems reduces the need to be right about any single outcome. Another insight appears repeatedly. International investing reveals the difference between growth and return. Some countries grow rapidly, but deliver poor shareholder returns due to governance issues or capital inefficiency. Others grow slowly, but reward investors consistently. Global investing books train readers to separate economic stories from investment outcomes. Books on the subject also emphasize humility. No investor understands every market deeply. Global investing works best when approached probabilistically rather than confidently. Index exposure, broad ETFs, and diversified funds appear frequently in these books, not because they are exciting, but because they reduce the cost of ignorance. Emerging markets receive special attention. These regions often promise high growth, but carry structural risks. Global investing books neither glorify nor dismiss them. Instead, they frame emerging markets as optionality, small allocations with asymmetric potential. The goal is participation without dependency. Another important lesson concerns regulation and governance. Not all markets protect investors equally. Books stress understanding shareholder rights, transparency standards, and legal recourse. Global investing is not blind trust. It is selective exposure. These books also discuss cultural context. Business norms differ. Accounting practices vary. Corporate governance reflects national history. Investors who ignore culture misinterpret data. Global investing requires curiosity, not assumptions. Time horizon becomes even more important internationally. Short-term volatility increases with unfamiliarity. Long-term returns depend on patience. Books emphasize that global investing punishes tourists and rewards settlers, those willing to stay invested long enough for structural forces to play out. Over time, readers notice a shift in perspective. The world feels larger, but risk feels smaller. No single country feels indispensable. No single narrative feels permanent. This mental diversification is as valuable as financial diversification. Global investing books also reframe patriotism. Investing abroad is not disloyal. It is pragmatic. Financial security built through diversification allows individuals to contribute more steadily at home. Another recurring insight is resilience. Empires rise and fall. Markets evolve. Global investing acknowledges this impermanence and designs around it. Rather than betting on dominance, it bets on adaptability. As investors progress through these books, urgency fades. The need to predict headlines diminishes. Global exposure becomes structural, not tactical. Portfolios are designed to endure regimes rather than exploit trends. And this is where the story begins to narrow. Because once investing is understood as participation in a global system rather than allegiance to a single market, fear loses its grip. Opportunity expands. Risk becomes more distributed, and wealth creation becomes less dependent on the fate of any one country, unfolding instead through exposure to many economies, many currencies, and many paths of progress. Like learning to sail, with the understanding that no single wind pattern lasts forever, and realizing that global investing is less about predicting where growth will appear next, and more about refusing to let one geography decide your fate. In the second half of this journey, global investing books become increasingly sober about what international exposure truly demands. They strip away the romance of foreign opportunity and replace it with a more durable truth. Investing globally does not reduce uncertainty, it redistributes it. And redistribution over long periods is what protects capital from historical surprise. One of the clearest lessons repeated across these books is that national dominance is temporary. Every era believes its leading market is different, more advanced, more stable. History disagrees. The Dutch, the British, the Americans, each enjoyed periods of global financial centrality, and each eventually faced stagnation, inflation, or relative decline. Global investing exists because no country is immune to time. This perspective changes how risk is understood. Domestic-only investors often believe they are being cautious. Global investing books argue the opposite. Concentration in a single political system, legal framework, currency, and demographic future is not caution. It is a gamble disguised as comfort. True conservatism spreads exposure across systems that fail for different reasons and at different speeds. Another recurring insight is that global investing forces humility. You cannot know every market deeply. You cannot interpret every headline correctly. These books teach investors to accept this limitation and design around it. Broad diversification, rule-based allocation, and long holding periods are not compromises, they are acknowledgments of reality. The goal is not brilliance, the goal is survival across regimes. Currency, revisited in the second half of these books, becomes more than a technical detail. It becomes a reminder that wealth is measured in purchasing power, not account balances. Global exposure protects against silent erosion. When domestic currency weakens gradually, investors anchored to one system often realize too late that their wealth has shrunk in real terms. Global investors notice earlier and suffer less. These books also caution against narrative-driven international investing. Chasing the next China or the next boom region often leads to disappointment. Growth stories attract capital early and punish it later. Global investing done well is indifferent to stories. It participates broadly, trims excess, and allows time, not prediction, to do the heavy lifting. Emerging markets are treated with particular nuance here. Books emphasize that their greatest risk is not volatility, but governance. Weak institutions, unstable regulation, and poor capital allocation can erase economic growth at the investor level. This is why allocation matters more than enthusiasm, exposure without dependency, participation without concentration. Another important theme is patience under discomfort. International markets feel uncomfortable precisely because they are unfamiliar. Volatility feels sharper. News feels harder to interpret. Global investing books warn that this discomfort is the price of diversification. Investors who retreat at the first sign of uncertainty turn global exposure into a source of stress rather than protection. Over time, successful global investors stop reacting to country-specific fear. They rebalance. They maintain structure. They allow mean reversion to work quietly. This discipline separates those who benefit from global investing from those who abandon it mid-cycle. These books also highlight a psychological shift that occurs with global exposure. When wealth is no longer tied emotionally to one nation's success, fear softens. Market drawdowns feel less existential. Political cycles feel less personal. Investors gain distance, and distance improves judgment. Another insight is resilience through optionality. Global investing does not aim to be right everywhere. It aims to ensure that somewhere, something is working. Innovation does not stop globally. Productivity does not freeze everywhere at once. Capital that participates globally remains connected to progress, even when one region stalls. As the narrative approaches its conclusion, the books converge on a quiet realization. Global investing is not about maximizing returns in the next decade. It is about preserving relevance over the next lifetime. It assumes change. It respects uncertainty. It prepares for outcomes that cannot be named in advance, and so the lesson resolves without drama. Global investing does not make you smarter than history. It simply refuses to bet against it. By spreading exposure across countries' currencies and systems, it transforms unpredictability from a threat into a condition that portfolios are designed to endure. If this reflection resonated with you, pause and consider how much of your financial future currently depends on one country continuing to do everything right. Awareness is the first step toward resilience. Share what this perspective shifted for you. And if you want to continue exploring books and ideas that prepare wealth, not for perfect scenarios, but for real history, stay connected and subscribe. Because the most durable portfolios are not built by those who guess the future best, but by those who prepare for the widest range of futures, calmly and consistently.